Have you ever really stopped to think about how a decision made by a few folks at the Federal Reserve can actually change the price of your coffee or the interest rate on your car loan? It feels like this giant, complicated mystery, right? Well, back in 1961, an economist named Karl Brunner published this incredible paper that basically gave us the key to unlocking it all. Today, we're going to dive into his work, some major problems in monetary theory, to see the hidden machinery that connects the big world of central banking to your wallet. Okay, so let's get right into it. We hear on the news constantly, the Fed is doing this or the Fed is doing that. But what does it really mean? How does a decision made in some Washington, D.C. boardroom actually end up affecting the price of gas or whether a local business can afford to hire more people? For a long, long time, the answer to that was surprisingly fuzzy. So if you rewind to the middle of the 20th century, that link between what a central bank did and what happened in the real economy, jobs, prices, all that stuff, it was a genuine puzzle. Economists knew something was going on, but they just couldn't agree on how it all worked.
Think about it like this. You've got a big black box. On one side, there's a lever that the Fed can pull. On the other side, there's a dial for the economy that moves. You pull the lever, the dial moves. But you have absolutely no idea what's happening inside the box to connect the two. That was monetary policy for decades. There were all these competing ideas, but none of them could really be proven, which meant that making policy was pretty much just guesswork.
And this is where Karl Brunner steps onto the scene. He looked at all this confusion and said, hey, for these policy discussions to even be useful, they need what he called cognitive respectability. Now, that's a fancy term, but all it really means is that economics had to get serious. It had to move past these vague, conflicting stories and build a clear, testable, scientific way to explain what was actually going on inside that black box. And to get that cognitive respectability, Brunner didn't just point out the problem. He actually proposed a solution. And it was a brilliant and honestly a surprisingly simple one. He basically took that mysterious black box and broke it down into two clear, understandable steps. This was the key that finally opened it up. What he was really doing was mapping out what we now call the monetary transmission mechanism. It's the official name for what's happening inside the box. That exact chain of events that connects a central bank's action to, well, your life.
And here it is, his big idea. It's so elegant. Step 1. What the central bank does has a direct, predictable impact on the total amount of money out there. Step 2. That change in the amount of money then reliably affects how much people and businesses actually spend. It's simple, right? But here's the most important part. It was testable.
All right, so let's dig into that first step. The entire process, according to Brunner, is anchored by one critical thing, the monetary base. So what is that? Well, the monetary base is basically the raw material of the money supply. It's the physical cash and the digital reserves that only the central bank can create out of thin air. You can think of it as the one and only lever that the Fed has complete and total control over. It's the very start of the whole chain reaction. Okay, so the Fed has pulled the lever. They've changed the monetary base. But how does that new money actually get out there and convince people to start spending? Well, that brings us to step 2 of the process, which Brunner cleverly called the spillover effect.
This is where it gets really interesting. When the central bank pumps money into the system, banks, companies, and people suddenly have more cash than they planned on holding. And they don't just stuff it under the mattress, right? They start what Brunner called a substitution chain. They look for other things to hold. First, maybe they buy financial stuff like stocks and bonds. But the process doesn't stop there. It keeps spilling over as they try to rebalance everything they own, and eventually that leads them to buy real goods and services, cars, new machinery, houses. And that is how a policy decision in a boardroom finally makes its way to Main Street.
Now, that is a fantastic story, but Brunner knew that a good story wasn't enough. He needed that cognitive respectability, remember? His theory had to stand up to the cold, hard data. And boy, did the data back him up. His research uncovered this incredibly stable and predictable relationship. He found that for every single dollar of that base money the Fed created, the total money supply out in the economy grew by about $1.5 to $3.5. This was the monetary multiplier. It showed that step 1 of his mechanism wasn't just a theory. It was a real, measurable, and powerful economic force. And get this, the really crucial part. This wasn't just some fair-weather relationship that only worked when the economy was humming along. The data showed that this predictable multiplier effect held up even during the absolute economic chaos of the Great Depression. This was a huge deal because it suggested the transmission mechanism was incredibly robust. So this led to a big debate. Some economists at the time said, okay, but maybe it's not the Fed. Maybe it's the commercial banks and their lending decisions that are really in charge. So which was it? Was the central bank's monetary base really in the driver's seat, or was it someone else?
Well, Brunner did what a good scientist does. He tested it. He used a statistical technique that let him isolate the impact of each of these things to see which one was really doing the work. And the results? I mean, they're just night and day. The connection between the monetary base, the thing the Fed controls, and the money supply is incredibly strong. But the link between what the commercial banks were doing with their reserves, it's practically zero. The evidence was crystal clear. The central bank was running the show.
So you might be asking, why are we talking so much about a paper from 1961? Well, because its impact was absolutely massive. It helped turn monetary policy from a mysterious art form into something much, much closer to a science. I mean, just look at the difference here. Before Brunner, policymakers were basically fumbling around with a black box, trying to make sense of all these conflicting theories. After Brunner, they had a clear two-step mechanism. It wasn't a crystal ball, it wasn't perfect, but it gave them a reliable map to work with, instead of just flying blind.
So the big takeaway is that Brunner's work made the whole game more predictable. It gave policymakers a much better sense of how to navigate the economy. And it completely changed the conversation, forcing economic debates to be grounded in actual data and models you could test, instead of just philosophical arguments. He really did bring that cognitive respectability he was calling for.
And all this kind of leaves us with one last big question, doesn't it? Brunner gave us this beautiful, clear blueprint of the economic engine. But if we understand the mechanics so well, why is steering the economy still so incredibly difficult and often so unpredictable? It just goes to show you that even when you have a good map, the road itself can still be full of surprises. Everything we've talked about today was based on Karl Brunner's truly groundbreaking 1961 paper. If you're curious and want to go even deeper into the nuts and bolts, you can find it published in the American Economic Review. Thanks so much for joining us.